my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with New York sugar market, or the ICE raw sugar contract. Now, I mentioned 2 weeks ago in my commentary how the prior 2 weeks of that, so that is 4 and 3 weeks ago, prices not only were caught in intraday indecisive moves, but intraday indecisive moves, with one notable series of price actions going on to a third countering level. That's a sure sign of intraday indecision, if anything is. Indeed, this went back so far as mid-April, with the end of the run-up from the March to April V bottom, when the market reached the 21st century 50% absolute Fibonacci line at 1809, and got stuck trying higher and stuck trying lower. Originally I put this down to the then overload of support below. I was not just talking about the big support congestion from the recent 50% Fibonacci line at 1681 and the 50% Fibonacci line of the big October 2016, April 2020 move at 1649, or even to the extension of the little lower down to 1633. No, I was talking about all the things in that congestion. The rising short medium moving average currently at 1709 and the rising medium moving average currently 1667, which both made golden crosses 4 weeks ago. That's a bullish cross. Plus the lower time, currently 1729 of the now broken December 2020 to April 2021 bullish Andrews pitch off, all were supporting the market, with the single 21st century 50% absolute Fibonacci line overhead at 1809, plus the more recent February to date downtrend currently at 1783, though it's only a 2-pointer, and that was all the resistance there was. Then 2 weeks ago I spoke, and here I quote, "Now don't get me wrong, on the surface we have what looks like strong support that can withstand some testing. However, that barging between levels since late April has left us with a possible bullish halfway hesitation measured move higher since the V bottom, or else since April. We have a possible triple top action. Neither solutions are clean or clear. Indeed, I feel as if I am repeating myself from a month ago. However, until we have a clear indication, the range on the wide is going to be between the supports 1630 to 1681 up to the 50% 21st century absolute Fibonacci level at 1809. Well, 2 weeks ago the market scythed down through the supports, gapping lower, and on that Friday reached down, touching the 1630 support, closing just over it and below all the other supports. Then last Monday the market dipped further down through the 1630 support, and for the second day I saw the market trying to fulfill a new pattern by closing below the neckline, currently 1641, of the late April to June head and shoulders top. Yes, the original triple top had morphed into what turned out to be a head and shoulders top over the same period. Last Monday's action was an attempt to trigger that head and shoulders top by closing well below the neckline, as the previous Friday had penetrated the neckline but closed actually right on it. There was only one response the market had to such bearish intentions, and it was an obtuse one. The market made a combined key reversal up and bullish engulfing pattern. You'd think this might be over for the bearish intentions. Not so. You see, we had contrary countering actions until last Thursday. That's when those bears out there finally gave up. Well, for now at least. We closed up and over the support band 1630 to 1681, with a medium moving average within it. We nevertheless saw the market hesitate on Friday, that's last Friday, with an indecisive spinning top. But today we've broken higher, over the short medium moving average and the April 2017 high, and challenging the broken lower time from below. So where now? Well, it was as I was going to put it 2 weeks ago. It was as I put it 2 weeks ago, and repeated also last week. This market is still, and I quote, going to be between the supports 1630 to 1681 up to the 50% 21st century absolute Fibonacci line at 1809. So 1630, 1681 up to 1809. So the support band, and then there's a specific number on top. That is until it changes, of course. You see, the excessive indecision is going to make a break for one day. For the moment, the recent head and shoulders top is dormant, and the bullish Andrews pitch up, well, I think it's on its way out, but the thing is, Very much depends if the market trails along on the underside of that pitchfork. It'll still be useful. Ice Europe white sugar. The recently drawn February to May bearish Andrews pitchfork continues to give the bearish angle of attack, though to be honest it hasn't been tested this past week that much, other than the avoidance of the middle time, currently at 408 even from above. Now the original move down started 3 Mondays ago when the market made a combined key reversal down and bearish engulfing pattern, which along with this new bearish Andrews pitchfork stymied the previous weekly key reversal up from 3 weeks ago. Indeed, by last week, a lot of the heavy lifting in the move lower had been done, with closes below all the moving averages, including the long moving average, which is currently 430.10. Prices started to approach the middle time, currently, as I say, 408 even, of the recently drawn February to May bearish Andrews pitchfork, as well as the April low of 414.30. However, most of last week was a lesson in avoiding these tests. The market making a bullish piercing line pattern on the Monday to halt the decline, so it was halted on the Monday, and the key reversal up on Thursday to turn prices back up again. This is best then exemplified by today's action, where we've pushed back up over the long moving average and in the process prices have been set to form a key reversal up today. So if we're closing tonight, which you seem very close to, over 428 even, then we'd be on. We have a daily key reversal up again today. Right now it very much looks that way. Please now note there is some free air above this long moving average up until at least the neckline, which is 445.10 of the April to June head and shoulders top. Question is, will the market take this easy path higher or develop further a larger pattern that has been in formation for the whole of the year so far? You see, I pointed out last week how the whole of this year can be seen as a very, very large double top, with the neckline of this pattern at the 38.2% Fibonacci line, the April 2020 to February 2021 move at 419.30. Doesn't look as if the market may turn back lower right now, but it is worth remembering. It was, as I put it last week, and I quote, "The thing to watch out for now is a confirmed breach of that 38.2% Fibonacci line, because if that happens, then there's the possibility of a move down to the 390 area. If we don't have that confirmed close below the 38.2% Fibonacci line, there's a distinct chance of the market not going sideways, but all the way back up again. Watch out." And that's the end of the quote. White premium spread. After a series of indecisive spinning tops from early May until just before the end of May, the market finally took a decisive, if not initially notable, bearish engulfing pattern 5 weeks ago to resume the fall that had been there since late April. 3 weeks ago, the market dropped down and closed below the neckline of the failed 2020 base head and shoulders top, currently at 75 even. Prices have accelerated lower over the last 3 weeks, closing below the relatively recent shallow uptrend, currently at 70 1/4, and down through plus closing below the congestion from late 2019 between 56 3/4 and 66 1/2. The market now has a new, though lowering support. It's the middle time, currently 52 3/4 of the big bearish May 2020 to February 2021 Andrews pitchfork, which seems to be showing the bearish angle of attack of this market, at least for now. Please note this is a declining support, as is appropriate for a bearish pitchfork, so please do not think it is any form of counter. No. To the overall bearish incentive, it's not. That is currently evident here, as it is pointed out 2 weeks ago, and I quote, "Until we see the market move out of this strictures," now talking about the bearish Andrews pitchfork, "then this bearish pitchfork will prevail." End of quote. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.